What are the different types of mortgages? Fixed interest rate for the entire loan term, typically available in 5-year, 10-year, or even longer terms. It's best for borrowers who want predictable monthly payments. Plan to stay in their home for the long term. Also suitable when interest rates are low and expected to rise. Variable rate mortgage. Changes with the lender's prime rate, typically with an initial fixed period before adjustments. This one is best for borrowers who are comfortable with potential interest rate fluctuations and believe rates may decrease in the future. It can be a good choice when interest rates are relatively low. Open mortgage allows borrowers to make extra payments or pay off the mortgage without penalties, but often has a higher interest rate. It's best suited for people who expect to receive significant lump sum payments or who plan to sell their home in the near future. Then there is closed mortgage, which offers a lower interest rate than open mortgages, but limits the ability to make extra payments without penalties. This one is best for borrowers who want the security of a fixed interest rate and do not anticipate making significant extra payments. Another option is high ratio mortgage, which requires a down payment of less than 20% of the property's purchase price, typically requiring mortgage default insurance. This is best for first-time home buyers and those with limited down payment funds. Conventional mortgage is a mortgage with a down payment of at least 20% of the property's purchase price, avoiding the need for mortgage default insurance. If you are a home buyers with a substantial down payment who want to avoid the additional cost of mortgage insurance, look into this option. Home Equity Line of Credit, or HELOC, allows homeowners to borrow against their home's equity, often with a variable interest rate and the ability to make interest-only payments. So if you are a homeowners who want to access their home equity for purposes like home renovations or debt consolidation while maintaining flexibility in repayments, you can check this option. High-value property mortgage is designed for high-value properties, often requiring larger down payments and very strict credit qualifications. If you are seeking to finance expensive homes that exceed standard mortgage loan limits, this is the option for you. And lastly, there is reverse mortgage, which is available to homeowners aged 55 and older, allowing them to access home equity without making regular mortgage payments, with the loan becoming due when they sell the home, move out, or pass away. So if your grandparents want to use their home equity for financial needs while continuing to live in their homes, look into this option. We will be back with more important information. If you learned something new, please subscribe and hit that bell icon to stay updated.